You're scrolling through your banking app at 11 p.m. on a Tuesday night. You see the balance, $47,000 in student loans. The monthly payment reminder hits $520 every single month for the next 10 years, maybe longer. And here's what gets you. You do the math. $520 times 120 months. That's $62,400 you're handing over for a degree you might not even be using anymore. You think about your friends who are buying houses. You think about that vacation you can't afford. You think about retirement, and honestly, it feels impossible right now. Look, you're not alone. The average student loan borrower graduates with $37,000 in debt. That's not me being dramatic. That's the Federal Reserve's 2024 data. But here's what most people don't realize. That $37,000 isn't actually what you're paying. Not even close. My name is Frank, and I spend way too much time researching about financial success and education. If you're someone who cares about his income and financial stability, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. What we're covering isn't some obscure loophole. This is a framework that works for anyone with student debt, and most financial advisors don't talk about it because it doesn't make them money. Here's the thing. When you look at your student loan balance, you're looking at a lie. I mean that literally. That $47,000 isn't what you're actually paying. You're forgetting interest. And here's where it gets really interesting. The interest doesn't sit still. It compounds. It multiplies. It's like a financial parasite that grows the longer you ignore it. Let me show you the actual math, because this is where most people wake up. Let's say you're like the average borrower. $37,000 in loans at 5.5% interest, the average federal rate right now, on a standard 10-year repayment plan. You pay $390 a month. Simple math says that's $46,800 total, right? But no, by the time you're done, you've paid $6,800 in interest alone. That $37,000 loan just became a $43,800 loan. You're paying 18% more than the original balance. Here's what most people don't realize. If you stick to this plan without optimization, you're watching your money work against you for a full decade. 10 years where every dollar of that interest isn't going towards your house, your emergency fund, or your future. Here's what most financial institutions don't want you to know. They profit from your passivity. Think about it. If you're making your minimum payment mindlessly, feeling like you're handling it, the lender is absolutely thrilled. They're collecting interest month after month, year after year. The system profits from your inaction. There's a psychological thing that happens with student loans. It's different from other debt. When you have a car payment, you feel it immediately. But student loans? They're abstract, a number on a screen. You pay, you move on. It feels manageable because you never see the actual impact. This is where it gets really interesting, because behavioral psychology shows that people dramatically underestimate the power of compound interest when it's working against them. A Northwestern University study found that 60% of student loan borrowers can't accurately estimate how much interest they'll pay over the life of their loan. The other psychological trap? The "I'm just glad I have a payment plan" trap. Look, I get it. A structured plan feels responsible. But handling your finances and optimizing them are completely different. Most people optimize nothing. They take the standard 10-year plan because it's the default, and the lenders count on it. Okay, so here's the strategy that actually works. And I want to be clear, this isn't get-rich-quick stuff. This is get-smart-quick stuff. Step 1. Understand your interest rate hierarchy. Not all student loans are created equal. Here's what most people don't realize. Federal loans and private loans have different interest rates, and they have different rules. Federal loans average around 5.5% right now. Private loans, they can range anywhere from 4 to 13% depending on your credit. If you have private loans above 7%, those are your enemy. They're the ones costing you the most money. Create a list. Write down every single loan, the balance, the interest rate, the lender. This takes 20 minutes. Do this today, seriously. Most people never do this, and it's literally the foundation of everything. I'm talking about a simple spreadsheet or even a piece of paper. Write it down. The act of writing it down forces your brain to actually confront the situation instead of just ignoring it psychologically. That's the first psychological shift, from avoidance to awareness. Step 2. Attack the interest rate, not just the balance. Here's where the math gets exciting. Let's say you have $20,000 in loans, $12,000 at 6.5% and $8,000 at 4.2%. The conventional wisdom says pay minimums on everything and attack the largest balance first. That's mathematically backwards. You should attack the highest interest rate first, because that's actually costing you money. If you put an extra $200 toward that 6.5% loan instead of the 4.2% loan, here's the difference. Over 5 years, you save approximately $1,800 in interest. That's not negligible. That's a vacation. That's an emergency fund starter. Now you might be thinking, Frank, isn't it better to pay off the smallest loan first for psychological reasons? And look, I get the appeal. Paying off that $8,000 loan first gives you a quick win. That's real. But here's the thing, that quick win costs you money. You're optimizing for emotion instead of results. This is what I call the balance method trap. It feels good, but it's financially inefficient. Instead, use what's called the avalanche method. Target the highest interest rate first. It's less fun emotionally, but it's the mathematically superior path. And honestly, once you see the numbers work in your favor, that becomes its own motivation. Step 3. The accelerated payment schedule. Here's the thing that really gets people excited when they understand it. You don't need to pay the exact amount the lender suggests. If your payment is $390 and you pay $490 monthly, that's just an extra $100. Here's what happens over the life of the loan. You shorten your repayment from 10 years to 7.5 years. You pay approximately $4,200 less in interest. You're done 3 years earlier. 3 years. You're not just paying off debt faster, you're freeing up $390 a month 3 years sooner. That $390 becomes your investment money, your house down payment money, your retirement money. But here's what most people don't realize. You don't need to find an extra $100 somehow. You probably have it. It's in your spending that you haven't even noticed yet. Cut the subscription you forgot you have. Don't eat out 3 Fridays this month. Boom! You just saved 3 years of your life. And here's the psychological benefit that nobody talks about. You start feeling progress. Every month, that extra $100 is doing real work. You're not just treading water. You're actively swimming toward the shore. That feeling compounds your motivation. You start noticing other areas where you can cut $50 here, $75 there. It becomes a game instead of a burden. Step 4. Refinancing strategy, if you qualify. Now you might be thinking, what if I could lower my interest rate altogether? For some of you, refinancing makes sense. If you graduated, got a job, and your credit improved, your refinancing options are way better than your original rates. The catch? Refinancing federal loans means losing federal protections like income-driven repayment. That's a real trade-off. But if you're earning solid income and you're confident in your job stability, cutting your interest rate from 6.5% to 4% on a $20,000 loan saves you over $2,000 in interest payments. Do the math. If you're saving $2,000, it's probably worth exploring. Look into companies like SoFi or Earnest if you're interested. Look, here's what I want you to understand about this strategy. It's not about suffering. It's not about deprivation or sacrifice. It's about being intentional with money. The students who win with debt aren't the ones that get lucky. They're the ones who understand that compound interest works both ways. Right now, it's working against you, but once you're debt-free, it works for you. That's the actual game. Every dollar you're not sending to Navient or Sallie Mae is a dollar that can grow in an investment account for 30 years. That's the real power of this strategy. If you found this helpful, hit that subscribe button, drop a comment, and tell me what's your biggest student loan obstacle right now. I genuinely read those, and sometimes the best video ideas come from your comments. And look, share this with one person who needs to hear it. Seriously, one person, because everyone deserves to know that their debt doesn't have to control their life. Thanks for watching. I'll see you in the next one.